All right, all of you guys are going to have 401ks, maybe, maybe not. Hopefully, all of you will have Roth IRAs, maybe, maybe not. Some of you, though, might want to go a little bit step further and actually trade stock on your own. So, really, you have to study it for a while. You might want to take a class. I mean, this tutorial is not going to really prepare you to trade stocks, but it'll give you an idea what it's all about. And that's kind of what the goal of the class is, to give you a basic understanding of all these concepts, and then from there you go in the direction that you want to go. All right, so what is a stock? Basically, stocks are a way for corporations to obtain capital to finance operations to grow and expand. So what they do is they issue, they're authorized to sell shares, and then they sell shares initially in a primary market, which we call initial public offering, and it goes to the primary market, and then once the primary market sells off all the shares, the money goes to the corporation, and then all the people that bought the stock are then owners in the company. From there, the investor could hold on to the stock, or they could go into what is called the secondary market, which you're probably familiar with, was like the New York Stock Exchange. When you turn on CNBC and they're broadcasting from the stock floor, that's the secondary market, and that's where stock is sold between investors. So when you go to buy stock, basically, when you read a chart, there will always be a bid price and an ask price. Right now it's 11 o'clock at night, so there's no one trading right now. But if we look here, we have Coca-Cola. Everyone's familiar with Coca-Cola. Coca-Cola makes beverages of all different types. They sell throughout the world. It's a very, very strong company. They sell the top two products are Coke and Diet Coke, are the top two drinks sold in the world. Diet Coke just surpassed Pepsi recently. But if we look at this, the stock trades at $39.76 a share. And don't confuse price of the share as it being a good or bad company, because some companies, when the price gets too high, sometimes they might split the stock. So if you have 100 shares and it's worth $100 a share, you're sitting on $10,000 worth of stock. And if they split the stock price, they split the stock price in half, but now you get double the shares. So instead of having 100 shares at $100 a share, you now have 200 shares at $50 a share. If you times 200 times 50, you still get 10,000. So really what's happening is what investors are willing to pay for a company. We call that price discovery. So buyers and sellers come together in a market. A lot of people that don't know stocks think that supply and demand determines the price of stock. It's actually the discovery at which people are willing to buy the stock and sell the stock for. Okay, so basically, a stock, the market opens up our time, Central Time, 8:30, closes at 3 p.m. And so during that time, stock is traded, and as you can see here, the average volume over the last 10 days, 15 million shares of Coca-Cola stock has exchanged hands. So on average, 15 million shares have exchanged hands. There's the 52-week range. And basically there's 4.5 billion shares held of Coca-Cola stock. So if you take the 4.5 billion here and times it by 39.76, the market capitalization of Coca-Cola is worth $177 billion. So that is a very, very, one of the largest companies in the world, obviously. Okay, so some companies, now why do people buy this stuff? Why do they buy stock? Well, let me go to a 5-year chart here. Let me kind of blow this up here. Internet. Okay, there we go. I'm going to show you the candlestick. So this shows you, the red means a down day, green is an up day. So if I go to a maximum time frame, so if we go all the way back, let's go back to when I was in high school, 1993, graduate high school, and right around June, there you go, Coca-Cola was trading at $10.75 a share. So if I bought Coca-Cola, today that stock, 20 years later, would be worth today's price of $39.76. So a lot of people think, well, it went up 4 times. Well, that's a pretty good investment, 4 times. But the thing about Coca-Cola, Coca-Cola is not going to go up to 200, 300 a share. It's a it's a very established company. It produces a lot of income for the owner of the company, and what they do is they take that income that they make and they pay out what is called a dividend. So when I come back to this screen, Coca-Cola pays 28 cents per share held every 4 months. They pay 28 cents dividend. So let's say if I own, let's say I own 100 shares of the stock. My total investment right now would be $3,976. 100 times 39, that's the share price, and then I would receive a check every 4 months in the amount of $28, 28 cents times 100 shares. So every 4 months I get a check for $28, $28. And what happens with a company like Coca-Cola is they're constantly increasing this quarterly dividend. A great company that you guys are all familiar with, whether you love them or hate them, McDonald's. Now, stocks are traded with a ticker symbol, so I typed in, we got to find the name of the company, and then we type in the ticker, and it gives us information. Coca-Cola pays us 77 cents per share dividend, and the beautiful thing about this company is that their dividend, they're always increasing this dividend payout rate. Whether the price of the stock goes up or down, it's always based off of how many shares you bought. So when I was in high school, let's do my high school example here again. McDonald's was trading at, let's go back to 93, was trading at $12, and we can see today it's trading at almost 100. It actually hit 100 not too long ago. So right now, there are different types of investors. Some people will buy the stock and hold on to it forever. They collect the dividends along the way. People will speculate and buy growth companies, and then some people will trade daily companies and try to read patterns and trade off the patterns. Right now, a company that's in the news is Tesla. Tesla is an electric sports car. And if we look at the action in the last month, you can see there's huge price swings in the stock. If I go to the 3 month, you're going to see a huge breakout here. And in my investing class, we really study what is called technical trading. So we read these patterns and we study these patterns to make our trades. Right now I'm having a little trouble here with the chart. Just bear with me. Come on. There it is. Okay, so there's the 3 month. And I want to look at this chart real quick. In May, think of what was going on in May in your life. Tesla was trading at $57, and all of a sudden it just broke out. In a couple of months short time, it broke out, and it got as high as $114 a share. This is a huge breakout. As a technical trader, we're watching this. We're watching to see if it gets back up to that 114 level. If it gets back up to that 114 level, then we watch it very closely. We might make a trade, because what that might form is what is called a double top. But this is a lot of information to throw at you and to kind of go over in a short tutorial. But basically what I want you to do is I just want you to see the process of buying stock and holding on to it, and kind of seeing what's going to happen, because you're going to have this portfolio and it's going to run forever. And you could trade in and out of this portfolio you're going to set up. You could buy it one time and never look at it again and just forget about it, or you could buy it and then a year from now open it up and see kind of where it's at. It'd be interesting to see. I made a great buy about, I don't know, I think it was like 13 years ago. Uggs. I didn't buy it in real life, but I bought it in the simulation. UGG was trading, the parent company was trading at, I think it was like $8 a share, and then of course Uggs took off and the thing went to like $90 a share, and that was like the only year I ever won the competition with my students, is because of UGG boots. But that's kind of what some of that information means in there. So what you're going to be doing, I want you to pick 5 companies that you'd like to become an investor in. Try to pick 5 companies that are in 5 different industries. And so you need the ticker symbol, and then you need to determine how much money you want to invest in the company, and then you divide it by share price. So for example, if I want to invest $5,000 into McDonald's right now, I would pull out my calculator and I would type in my calculator. Well, I'm getting my calculator here and another on my phone. You know how that goes. So I type in my calculator, $5,000 divided by, it's trading at $99.55, and I divide it by $99.55, and I get roughly 50 shares. So if I wanted to invest $5,000 into McDonald's, I would buy 50 shares of McDonald's to equal that dollar investment. All right, so that's what we want to do. We want 5 different companies, and then you're going to have $50,000, and you could weight it. Obviously, I'm not going to let you put all your money into one company, so I'm looking for you to pick 5 different companies and try to mix up the industries. Don't pick like 5 car companies, or because what happens sometimes industries get hit hard and you could lose money quickly. One of the more stocks that you guys are going to probably buy, and you guys always buy this, is Apple. And if we look at Apple here, if I go to their 1-year chart, you can see that what is the trend of Apple. Everyone thinks Apple is great, but if you look at the trend, Apple is actually traded down. When a stock trades down like this, we call this a bear market. This is definitely, Apple has been in a bear market. It has been down. People have sold it off. It's been beaten up. It actually hit 390 right in this area. And so now we saw a bounce off of that, and now it's coming back down off that bounce, and now it's trading at 413 as of Friday. So with these chart patterns, you could read them and trade off of that. One stock that I'm looking at right now is the 10-year Treasury. This is an exchange traded fund, and in your 1-year assignments, you talked about ETFs. So this represents the 20-year Treasury bond fund, and basically it kind of corresponds with interest rates. Right now we're seeing interest rates jump. So what happens to bonds when interest rates jump? Bonds go down. And you can see in the last month, this sucker is just trading off pretty heavily, because in this range here, we saw interest rates have started to trade up in the last few trading sessions. So this one's kind of getting beat up right now. If you think that interest rates are going to continue to rise, this would be an area you might want to take a look at to trade in. So it'll be interesting to see what happens in the upcoming weeks with this particular trade. Alright, so the next video will be quickly show you how to work Investopedia.